Hey, how's it going, guys? Welcome to the Module 1 of Options Trading Foundation, the complete options trading course for beginners. Module 1 is all about options trading basics. There are 5 different sub-modules in Module 1 covering 5 extremely important topics in options trading. In this video, we'll start from the sub-module 1.1 and help you guys understand what exactly is an option. Alright, let's get started. We all know option is a financial derivative that we can trade to make money. But what exact the definition of options? An option is a contract that offers investors the right to buy or sell the underlying assets at a fixed price within a fixed time frame. This is the most complete and accurate definition of options. To understand this definition, we need to understand this couple of keywords. First is the contract. Option is basically a contract or an agreement between option buyers or sellers and the underlying asset owners. Option traders do not own the underlying asset. They purely trade the value of different option contracts and make profits. The value of an option contract is determined by 3 major factors: underlying asset price, or the intrinsic value, and the time value, and then the implied volatility. We will get into all these 3 factors with much more details in the module 1.3. There are 2 types of option contracts: the call option and the put option. The call option allows investors to have the right to buy the underlying asset at a fixed price within a fixed time frame. On the other hand, the put option allows investors to have the right to sell the underlying asset at a fixed price within a certain period of time. So, what exactly is this right that an option contract can offer? Right means that you're in control. When you own an option, no matter it's a call option or a put option, you're the one can choose if you want to buy or sell the underlying assets by the end of the contract period. The exact opposite to the right is the obligation. You will have the obligations when you short an option contract, or some traders prefer to call it the right an option or sell an option. They basically mean the same thing. They basically mean that you are no longer in control of the underlying assets. Instead of having the rights, now you are having the obligations to buy or sell those underlying assets at a certain fixed price by the end of the contract period. Of course, there's no free lunch. In order to have the right, you have to pay the premium to buy the option contract. On the other hand, you can also get paid as a profit by selling or shorting an option contract to compensate for the risk of having an obligation. This concept of the rights versus obligations, paying premium versus getting paid in forms of premium, are extremely important for designing options trading strategies, which we will discuss in the later modules. If you are still confused by the relationship between buying or selling options and owning rights or obligations, then this chart will definitely help you understand much better. For example, when you buy or long a call option, you will have the right to buy the underlying asset at a certain price in a certain time frame. On the other hand, when you short a call option, you will now have the obligation to sell the underlying asset. Same for the put option. When you buy a put option, you will have the right to sell the underlying asset at a certain price in a certain time frame. But when you short a put option, you will now have the obligation to buy the underlying assets. If you are new to the options trading, this is the chart you should definitely remember. Alright, the next keyword you should understand is the underlying asset. Underlying assets can be any tradable securities, such as stocks, bonds, properties, commodities, or even currencies. In this course, I will mainly focus on stocks as the underlying assets. If you are in the US or trading the US market, one option contract can give you the right to buy or sell 100 shares of an underlying stock, regardless of the share price. For example, let's say you just bought one call option of Apple. Then this call option contract allows you to have the control over 100 shares of Apple stock. If you buy 2 options, that will be 200 shares. The total cost of one option contract is equal to the premium of that one contract, which is traded in the public options market based on the supply and demand, and then multiplied by 100, simply because it covers 100 shares. Every underlying asset has a market price and it keeps fluctuating. One of the key features of trading options is that it allows traders to fix a desired preset price that they're willing to pay over the underlying assets when they put on a trade. And that fixed price is also known as the strike price. A strike price is basically the preset price for the underlying stock that will be exercised by the end of the option contract. Once an option contract is established between a buyer and a seller, no matter how much the underlying asset price will still keep moving, the strike price will not be changed. Whenever we talk about the strike price in options trading, we will always have to talk about the one extremely important topic, and that is the moneyness of an option. The moneyness basically describes the relationship between the strike price of an option contract and the asset price under that option. We'll go into much more details in the submodule 1.3. Another important key feature of an option contract is the fixed time frame. It's also known as the expiration date. So what exactly is this expiration date? The expiration date is basically the last day before the option contract goes either exercised or expired. Your option will be automatically exercised if that contract is in the money or at the money on the expiration date. But if your contract is out of the money on the expiration date, then your contract will be expired worthless. One thing you should understand in options trading is that an option contract goes expired worthless is not necessarily a bad thing. Sometimes this could be exactly what you want for some certain trading strategies, especially those involving short selling options. I will teach you exactly how you can do it in the module 3. In the US market, the expiration date of any option contract is usually the third Friday of each month, and all the options are only tradable before the expiration date. Same as the strike price. Once the option contract is established between buyers and sellers, it cannot be changed, unless you buy or sell a new contract with a different expiration date. Alright, so when you fully understand these keywords, then you will be able to understand what exactly is the option, and move on to learn how to trade options as a financial instrument. As mentioned earlier, there are only two types of options that we can use, the call option and the put options. All the options trading strategies in the world are basically the different combinations of these two. If you are still confused by what exactly is a call option or put option at this point, you don't have to worry. In the next module, the module 1.2, I will go into much more details with real-life examples to help you guys fully understand what is a call option, what is a put option, and how the traders use them. Cool, before we end the module 1.1, I just want to quickly share with you guys the top 4 reasons why trading options is a much better way to play the stock market than just trading underlying stocks directly. First is the high cost efficiency to your initial capital. Option is a highly leveraged instrument. For example, if the stock is trading at $80 and with a call option at $10, if you buy 200 shares of this stock, that will cost you $16,000 out of your initial capital. But if you buy a call option instead, it will only cost you $8 to have the full control of 200 shares. Second, even with a small amount of initial capital, options can still offer a much higher potential return than buying stocks directly. One obvious reason is due to the high leverage. The other not so obvious reason is that the premium of an option contract is extremely sensitive to the implied volatility of the underlying assets. Traders can make a great profit in a very short period of time when the implied volatility changes quickly. Third, option is one of the best instruments to manage the downside risk. If used properly, trading options are actually much safer than trading stocks directly. Also, options offer pretty much the best tool to hedge any long-term investment portfolio with any sizes and strategies. And finally, trading options is much more versatile compared with trading stocks. It offers the most choices when it comes to designing different trading strategies according to different market conditions and trade signals. No matter if you're a long-term investor who is relying on the fundamental analysis, or a short-term trader who is heavily relying on the technical analysis, or even maybe you are a quant algo trader who is purely based on the quantitative analysis, option can offer the best instruments that you can use to design your own game plans. No matter what kind of investors or traders you are, there is only one thing you need to make consistent profits in the financial market, and that thing is called the edge. But the moment you find your edge in the market, the next key question for you will be how you can maximize your potential return with a minimal amount of risk. And that's exactly where options come into play. Options allow traders to take advantage of any edge that you can find in the market, maximize your potential return over the edge, and minimize your downside risk. If you are new to the options trading, this should be your #1 goal of learning how to trade options. Alright, that will be the end of this module 1.1. In the next module, I will share with you guys the best way to fully understand call and put options and how to use them in options trading. If you are new to this channel, my name is Vic. I hope you guys enjoyed the course so far. If you find my contents have been valuable to you, please consider subscribing and helping me click the like button on this video. It can really help reaching out to more people who need this content. Also, please turn on that notification bell so that you will never miss any module in the future whenever I upload. Again, thanks so much for watching guys, and I'll see you guys in the next one. Bye for now.